At some point in our lives, we all considered buying a house. Whether it be for ourselves, our family, or for future investments, it all crossed our minds, one way or another. Often associated with these decisions is one of the most common questions we all have in these types of big purchases. Will it be paid through spot cash or bank financing? Or if financed through loans, how much should you borrow and how long should the repayment term be? We'll be digging through historical data and crunching the numbers to give you an idea on how these work and help you decide on the best course of action for your purchases. Since the data sets vary in different countries, I'll be focusing on the Philippine market, but in a general sense, this could still be applied to different places as well. To start off, we'll be identifying these terminologies to avoid confusion and to get everyone on the same page. Spot cash, or commonly referred to as full cash payment, is when the buyer pays the agreed amount in full upon the transfer of ownership of the property. Usually, this does not include any third party, and all the funds used for the payment will be coming from the buyer's own account. Bank financing, on the other hand, utilizes loans issued by banks which are then used by the buyer to pay for the property. There are also multiple iterations of this financing model and are commonly referred to as in-house financing and government financing, but the concept is the same. What usually differs is the interest rates and the convenience and approval of these loans. Due to various factors in the economy, interest rates on home loans are very fluid and change annually. This is where locked-in interest rates come in, where banks offer fixed annual interest rates for a specific period of time, and borrowers can leverage this option to protect their loans from increasing annual interest rates. Loan terms, on the other hand, is the length of time the loan will be paid in. For example, in 5, 10, 15, 20, or 30 years. I also bring up liquidity a couple of times in this video, which just means cash in this context. Now that we understand what these terms mean, we'll be moving on to the pros and cons of these options when paying for your property. Understandably, spot cash is the most optimal mode of payment, just because of its straightforward and simple nature, where the buyer withdraws the full amount from their account and uses it to pay the seller in exchange for the property. This also gives the buyer some leverage to negotiate some form of discount from the seller for the full payment. In some cases, about 10% of the total contract price. Once the transaction is completed, the buyer now has total ownership of the property with no financial obligations to worry about from any third party. This means no monthly mortgages to lose sleep over. But this has its own caveats as well. For middle and lower class individuals who can afford this method, paying in full equates to completely draining liquidity, or, in simple terms, running out of cash, which can heavily limit one's ability to invest on other opportunities and also be a very risky move, especially in times of emergencies where cash is needed. Though paying in full can be beneficial in the long run, always make sure that there is enough liquidity left for unforeseen events until your funds have recuperated to comfortable levels. On the other hand, bank financing has been the go-to payment scheme for most homebuyers, mainly because of the flexibility it offers for individuals who could not afford to pay the property in full, and also for those who don't want to risk and lock the majority of their liquidity in a single asset. Giving individuals the opportunity to pay for their properties in bite-sized amounts relative to the total contract price, in exchange for a significantly larger repayment amount for the whole payment duration. A rule of thumb in these cases would be the larger the down payment on the property, the lesser the monthly payments for the loan. But this is still relative to the duration of your loan payment. Always remember that the longer it takes to completely pay for the loan, the larger the repayment amount would be. I hope you're not confused with these concepts yet, as it only gets more cumbersome during the application process for these home loans, lasting for a couple of days to a couple of weeks in some instances, where prospective borrowers provide relevant documents like proof of income, valid government IDs, income tax returns, and many more supporting documents for the home loan. But this is just the tangible part of the process. Banks still have to check your credit history, your capacity to pay, and collateral for the loan, usually followed up with a personal interview from the bank's underwriter. Despite all these efforts, approval of these loans are not guaranteed, but some banks allow individuals to reapply after a set amount of time after being rejected. Also put in mind, that properties bought using home loans are often used as collateral in cases where the borrowers fail to pay their loans. On paper, the borrower is the owner of the property, but the banks could take ownership if the borrower defaults on their payments. As of 2023, and based on multiple anecdotal evidence from borrowers in the Philippines, home buyers can lock in annual interest rates of their loans at around 6% to 8% for 3 to 5 years. But the challenge usually comes after the lock-in period, where interest rates in some cases can go as high as 9 or 10%. Fortunately, borrowers can request for rate adjustments, and banks sometimes reduce the increased rates by 0.2% to 0.5%. However, some banks have processing fees for these rate readjustments, so be sure to inquire with your bank about these fees. With this information in hand, you might be thinking of locking in your rates for 10 or so years to protect yourself from these interest rate increases, but this is not recommended. Longer lock-in periods equate to larger interest rates ranging from 7 to 10% or even more. You'll also be paying more in the first few years if you lock in for longer periods because of the larger interest rate. The sweet spot for these lock-in or fixing periods is around 3 to 5 years, where interest rates are manageable if you're looking forward to bank financing. All these amounts are always relative to your loan term. Longer loan terms will equate to a larger repayment compared to shorter loan terms. Most people prefer longer terms mainly because of its lower monthly payments, but as much as possible, choose the shortest term relative to your earnings and cost of living. That way, you'll be out of your debt soon and pay a lesser loan amount without sacrificing too much of your daily needs. Similar to bank financing, in-house financing, which is offered by developers of the property and their financial partners, is much more convenient and processed faster. However, their annual interest rates can be significantly higher, around 8% or more. This is usually the last resort for homebuyers that have been rejected multiple times by banks for various reasons. Government financing, on the other hand, have very forgivable annual interest rates that go as low as 5%, but cater mainly to low-cost housing properties and have a cap of 6 million pesos on their loans. Unfortunately, some developers don't accept government financing, and home buyers are limited to bank financing or in-house financing in these cases. Thank you for reaching the end of the video, and I hope I was able to help give you an idea on the financial options in purchasing your properties. If you have further recommendations or ideas that can also help other future home buyers, please don't hesitate to drop a comment below. If you enjoyed this presentation, please like and subscribe, or even share it with your friends or family to spread information about these topics. See you next week on my next video.